In this video, guys, we're going to look at useful trading clues from the close. Stay tuned. Hey traders, warm welcome to you. So useful trading clues from the close. Now, what do we mean by this? So the idea of looking at the close is this. Now, close is a time when in equity markets, for example, a bell will go. So London Stock Exchange bell goes, no more trading on that stock. Bell goes, New York Stock Exchange, yes, you might get some after hours trading, but that's really when like options will stop trading, money will stop flowing. And if we look at kind of forex markets, there's no bell as such, but as trade transitions from US to Asia, from Asia to Europe, from Europe, etc., there is a point where even though there's no bell, it's when everyone's saying, okay, well, that's the close in inverted commas. That's when other interrelated markets close as well. That's when money flow stops. So whilst we don't always have a definite, that's it, pens down, money down, no more trades, we do often have, blending in, but there's still a benchmark where everyone's looking at this. Everyone is seeing this in newspapers. Everyone's seeing this as asset managers, and everyone is looking at this as a key point. And everyone has used this as a final benchmark to get all the orders done. So that's why it's so useful, even though it's just a point in time in the day. Okay, so useful trading clues from the close. The reason we want to look at the close and we want to look at the clues is that we can then come up with a hypothesis and trade ideas looking for the next day. So let's look at some examples. So if we've got a market here, we've been chugging along and today has kind of pushed up and we've closed up here right at the high point. What do you think that tells you? That tells you that supply-demand imbalance was in the demand phase all throughout the day. It also tells you that it closed right at the high, which would indicate, unless it just happens to be the end of that person or the end of that demand phase, the likelihood is the next day we might see some demand coming in. Now, does that mean there's going to be no supply coming in? No, it doesn't. It could mean that people see that and think, well, I'm going to smack it, and we might have massive demand and massive supply, which, as we know, if you've watched one of my videos, means it doesn't matter if you've got huge demand, a huge supply, one cancels the other out and we don't go anywhere. Okay, you have to have a disproportionate amount of one or the other for the market to move one way or the other. So the position of the close, is it at the high in the trend? Has it done a full reversal? Oh, I love those ones. I can get excited by those. The ones that are there and the close, they come back down, take out lows and close there. You think the next day is going to be rallying back up to high? Could be. Chances are, though, that thing's going to flip and go even lower. It's these little clues because people aren't looking at the position relative to other things. They're just looking at the number and saying, well, that doesn't mean anything because yesterday we closed here and we're down 10 pips or we're down 10 cents. Who cares? Yeah, but we do care because this thing was up 2% and it's now reversed intraday. Now that's a really nice example and we don't get those very often, but that's the point. The point is, where's the position relative to the day's trade, the prior day, the prior week? And I talk about this in videos where we talk about the useful trading clues from the open, and go and check those out if you fancy looking at that as well. And a similar theme but using the open is it's the relative position that's so useful and important to us. It's not the actual finite number, it's how is it relative to the day, to the prior week. Now the prior week might be completely irrelevant if it was down here and there's nothing in it to do with it, but it might be super relevant if that happens to be the low of the week or the low of the month or something like that. You can see how you only bring in prior data or prior price action when it's relevant to the current price action. So position, are we at the top end of the range, are we at the low end of the range, or majority of the time, guys, markets are just sitting in the middle and it just closes somewhere in the range, in which case there's no edge to be gained from it. And that's going to be the majority of the time. I'm not going to stand here and say, hey, every single close we can get a super duper edge from stuff, because it'd be a lie. It's not the case. Majority of the time, the close just closes somewhere in the middle of the range of the day, which is in the middle of the week somewhere, which is kind of up a bit, down a bit. There's nothing going on. There's no edge. And that's, just to sort of digress very slightly, that's the danger a lot of traders make, is they try to see something that's not there. Assume nothing is there until it is, if that makes any sense. So assume the majority of these closes are going to be completely irrelevant. There's going to be no kind of information to be gleaned from it whatsoever. But every so often, there's a little nugget and you can go, aha, that's useful. That's telling me something. That's telling me supply demand has shifted. Or, like I say, if we're closing at the highs, it's telling me demand has stayed steady all throughout the day. And vice versa, guys. This is not just for momentum trades. Let's just say we had a scenario like this and we come down, we kind of chopped around and we close in the middle and assume that this was a little bit more two-way range as well. What is that telling us? That's telling us, well, mean reversion, guys. Let's play the mean reversion game at the moment. Let's assume the rest of the week was like that as well. Let's say, okay, the close is confirming we're still in mean reversion mode. It closed right on the VWAP, for example. It closed right in the middle of the range. It closed right, even on the upper end of the other range, but nothing excessive. We're in mean reversion. We might be drifting up in an uptrend over kind of a daily very slowly, but we're not rocketing. And if we're using mean reversion and we're in a kind of smaller uptrend, let's at least use mean reversion on the long side. Let's at least wait for kind of stretches to the downside to go long, so we're aligning ourselves with the broader trend. So that's the first thing, the price position relative to what's going on. Now, this is slightly different for the open and the close, the range. Now, the open, we've got a definitive number, like first 15 minutes, first hour, first half an hour, or whatever it may be. But with the close, now, to me, I like to see what's happening in the final hour, final 30 minutes. 15 is a little bit too tight for me, but that's interesting because that often tells you the urgency and often tells you whether liquidity has been available to dealers and traders. Let me explain what I mean by that. So if the market's been kind of chugging along and nothing much is happening, then in the close we get a good spike into the close. That sometimes says that these guys, or who I would say these guys, could be a massive different amount of people, but have had a lot of buy orders to execute throughout the day, have not been able to execute it without adversely affecting price, and so algos generally, or execution algos, especially in the spread off over a day or period of time, will get more aggressive as we come towards the end point. So the end point being the bell. They may say, well, actually, I've tried. Now we get kind of a lot of those algo type trades saying, okay, the final hour, we need to sacrifice price a little bit now because we need to get the order done. And that might be an intervention, it might be automatic, whatever it may be. And so the range of that final hour or the final 30 minutes often tells you who's interested in this market. If it does no range, if an hour before the close, 30 minutes before the close, it's sitting almost where it was at the close, no one cares, right? It's a bit of buying, bit of selling, back and forth, very, very slow. And liken it to the pit, okay? When you listen into the pit, ages ago, you used to listen into the pit audio and you'd have just literally chatter. Like you could hear guys talking about football games. You could genuinely hear just chatter. A few deals going through, price would go up a bit, price would go down a bit. Compare that to when things were really kicking off and getting spicy, and all you'd hear is raw, and you'd hear massive elevated audio when everyone was getting urgent. And that's kind of how you need to perceive it in electronic mode. So if we see kind of big spikes into the close in the final hour, assume that the pit's roaring. Yes, we can't, it's not quite the same, but assume that orders are roaring through, and it means that a lot of people are sacrificing price for urgency, which means that we can say, okay, the next day we can hypothesize that there was supply demand imbalance going into that final hour. What could happen the next day? Okay, well, let's just put it all into perspective. Let's look at the position, let's look at the range, let's see exactly what these things mean to us, and let's put them into the bigger picture and see if there's something going on. Right, guys, part 2, we're going to look even deeper into this. We're going to come up with some kind of broad setups as to how we could use the position, how we could use the range, how we could look at it relative to the day's position, and more importantly, any setups we can come out from that. Take care. Bye-bye.